Hey everyone, welcome back to Corporate Decoder. Today, Athena Technology Acquisition Corp, the SEC, just filed an 8K and I am seeing a significant shift in their business combination plans. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is outlining a major update to a deal that could change its direction. And there is a key detail about stock that investors need to understand. So what is happening here is Athena Technology Acquisition Corp, THERB, which we can call Athena for short, has filed a document that tells us about some big changes. Think of this like a public announcement for important company news. The main event happened on the 18th of April 2026. This filing is about events that happened that day or shortly after. Athena itself is a special kind of company called a SPAC, which is short for a special purpose acquisition company. SPACs are created with the sole purpose of raising money through an initial public offering to then acquire or merge with an existing private company. It's like a shell company looking for a business to buy. There are some standard details here, like where the company is registered, its file number, and an identification number. These are like the company's ID tags. And here is where their main office is located, though this isn't a focus for us. This little checkbox being ticked tells us that Athena is using this filing to share written communications that are part of a public offering. This often means they are talking about the deal that is about to happen. Athena is identifying itself as an emerging growth company. This is a designation for newer public companies that get some regulatory benefits, meaning they have a bit less strict reporting requirements compared to older, larger companies. Now, this is where things get interesting. Item 1.01 is all about entering into an important agreement. And the agreement they're talking about is an amendment, meaning they are changing an existing deal. The agreement is called a Second Amendment to Business Combination Agreement. A Business Combination Agreement, or BCA, is the contract that lays out the terms for two companies to merge or one to acquire the other. So they are not just making a small tweak, they are making the second major change to the original plan. The original agreement was made way back in December 2024, and they already amended it in March 2026. Now, in April 2026, they're amending it again. This amendment is between Athena and another company called A-Screen Recycling, Inc., which we'll call A-Screen. They are changing their original agreement. The biggest change here is about A-Screen's stock structure. They are increasing the number of preferred shares A-Screen can issue. They are going from being able to issue 1 million preferred shares to 5 million. Why would they do this? Well, it is to allow for the issuance of a specific type of stock, 12.0% series accumulative convertible preferred stock. This is a mouthful, so let's break it down. Preferred stock means these shares have certain advantages over common stock, like getting paid dividends before common stockholders. Cumulative means if they miss a dividend payment, it adds up and has to be paid later. Convertible is the really key word here. It means these preferred shares can be turned into regular common shares of the company. They are doing this to fund something called a PIPE investment. A PIPE investment stands for Private Investment in Public Equity. It's when a public company, or in this case, a company that is about to become public through a SPAC merger, sells its stock directly to a group of private investors. This is a common way for companies going through SPAC mergers to raise additional capital. So, just a few days after amending the original deal, on the 21st of April, Athena and A-Screen signed what are called securities purchase agreements with these private investors, the PIPE investors. The investors agreed to buy a large number of these series of preferred stock shares, over 3.3 million of them. Each share has a tiny par value of just 1/10,000th of a dollar, which is standard for accounting. The crucial part is that these shares can be converted into common stock. The initial price at which they can convert is $12 per share. This means if the common stock goes above $12, these preferred holders might convert their shares, potentially increasing the number of shares outstanding. On top of the preferred stock, the investors are also getting warrants. Warrants are like options, giving the holder the right to buy shares at a specific price. In this case, they get warrants to buy another 5 million shares of A-Screen's common stock, also with an initial price of $12 per share. They are paying a total of $32 million for all of this. This $32 million is the PIPE investment. And as if that wasn't enough, the PIPE investors are also getting an extra 1 million shares of common stock as a bonus for participating in this deal. This is often called sweetener stock. This whole deal, the PIPE investment, is expected to close at the same time as the main business combination between Athena and A-Screen. However, there are conditions like the stock needing to be approved for listing on major stock exchanges like the NYSE or NASDAQ. The money raised from this PIPE deal is meant to help finalize the business combination. This section covers sales of stock that aren't officially registered with the government. This is common in SPAC deals and PIPE investments. Here, they are stating clearly that the preferred stock and warrants sold to the PIPE investors are not being registered under the main law for securities. The Securities Act, they are using an exemption, Section 4, Add 2, which is for private transactions not involving a public offering. This is standard for such deals. But it means these investors are likely sophisticated and the shares might have restrictions. This section is for other significant events that don't fit neatly into the previous categories. One of the things that came out of this PIPE investment is something called a registration rights agreement. This agreement is basically a promise from Athena to the PIPE investors. It says that Athena will file paperwork with the SEC to allow these investors to easily sell their shares of A-Screen common stock, including any shares they might get from converting their preferred stock or exercising their warrants. It's a way to make sure the investors can eventually cash out. And lastly, there is a mention of a press release that came out on the 23rd of April 2026 announcing this PIPE investment. Now, we always see this section in these filings. It is a warning about forward-looking statements. These are statements about what the company expects to happen in the future. They are essentially saying don't completely trust these future predictions because a lot can go wrong. They list a bunch of potential risks, and it is important to pay attention to these. One of the first risks highlighted is that A-Screen, the company they are merging with, has not been around for a long time at a large scale. They are building a new facility in the US, and expanding operations always comes with uncertainties and risks of running out of cash, which is called liquidity risk. They might not be able to get enough money to actually do what they plan to do. This is a pretty direct statement of risk. Hiring the right people and managing the engineering side of things when you are growing can be tough. If they can't handle these challenges, their growth plans might fail. Building new facilities can hit snags with permits and government rules, which could cause delays. This is a big one. A lot of A-Screen's money comes from just a few big customers. If those customers don't pay up or stop ordering, it could really hurt A-Screen. This is a common risk for companies that aren't diversified in their customer base. A-Screen deals with recycled materials, and the prices for these can go up and down a lot depending on what is happening in the world. This price instability can make their profits unpredictable. They depend on other companies to provide them with important machines. If those companies can't supply or maintain the equipment, A-Screen's operations could be seriously disrupted. If people and businesses stop adopting green energy solutions, that could mean less need for A-Screen's recycling services and products. A-Screen has special knowledge or technology, but competitors could catch up or even surpass it, weakening their advantage. Bad economic times or global political issues could slow down A-Screen's expansion and growth. Not all of Athena's or A-Screen's shareholders might vote in favor of the merger, which would stop it from happening. The stock of the combined company might not get approved for trading on NASDAQ, making it harder for investors to buy or sell shares. Something unexpected could happen that causes the whole deal to be called off. One of the requirements for the deal to be finalized might not be met. The finalization of the merger could take longer than expected. Just talking about the merger publicly could make the stock price go down, which is often called market reaction risk. There is always a chance someone could sue over the merger. And finally, they point to other risks mentioned in their full annual reports or other SEC filings. This is standard boilerplate to cover their bases. They are also pointing to another document, a registration statement on Form S-4. This document is typically used for mergers and acquisitions and contains a lot more detailed information about the combined company and the terms of the deal. This next part is a legal disclaimer. They are explicitly stating that this report is not an attempt to sell or buy any securities. It is informational only. They are careful not to make any promises or offers. This section reiterates that this report is about the business combination and that more detailed information can be found in the registration statement they filed with the SEC. They are directing people to the SEC's website or to contact them directly for free copies of these documents. Here, they're talking about who might be involved in asking for votes from shareholders. It is a disclosure about who is trying to get investors to approve the deal, and that information about them is in the registration statement. This is the last main section, detailing the attachments to this filing. Exhibit 2.1 is the actual document for the second amendment to the business combination agreement. This is the core document that details the changes we've been discussing. Exhibit 10.1 is the form of the purchase agreement for the PIPE investment. This is the contract that outlines the terms for the private investors buying into the company. Exhibit 10.2 is the registration rights agreement we mentioned earlier, where Athena promises to help the PIPE investors sell their shares. Exhibit 99.1 is the press release they issued about the PIPE investment. Finally, we have the signature section. This is where authorized individuals sign off on the filing, making it official. Isabel Friedheim, the CEO and chairperson, has signed this. So, what does all this mean? Athena, a SPAC, is pushing forward with its plan to merge with Ace Green Recycling. They've amended the deal for the second time, largely to accommodate a significant PIPE investment of $32 million. This investment involves selling preferred stock and warrants to private investors. While this infusion of cash is intended to support the merger, it also introduces new complexities. The preferred stock can be converted into common stock, and the warrants give investors another way to acquire more shares. Both of these could increase the total number of shares outstanding, which is called dilution. Ace Green, the target company, faces a number of significant risks as it tries to scale up its operations, including reliance on a few key customers and potential volatility in the prices of its materials. The fact that they are amending the deal multiple times and that the PIPE investors are getting extra shares suggests that getting this deal done might be more complicated than initially planned. The company is also clearly flagging a lot of risks in the forward-looking statements section, which is always a signal to tread carefully. The success of this deal hinges on meeting the conditions, like getting the stock listed on a major exchange and ultimately on Ace Green's ability to execute its ambitious growth plans despite the stated challenges. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.